This is TreppWire Week in Review for week ending January 28th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Darren King, Head of CMBS. This week, markets have been on a wild ride as investors digested news. The Fed signaled that it will raise rates as soon as March to head off inflation, and Russia-Ukraine tensions stoked some concerns. Economic data was a mixed bag. GDP surged in the last 3 months of 2021, but a number of corporate earnings reports have been disappointing. Durable goods posted a decline last month, and consumer confidence fell in January. Manus, how does the market volatility impact commercial real estate, or does it even?
Wow, what a week, wasn't it? Incredible ups and downs, starting with the football over last weekend. We saw some extraordinary games, which got my heart pumping even before Monday morning. And it just kept pumping harder and harder over Monday and Tuesday. We'll get into that in just a second. I will point out that this is a rare doubleheader for the Trepp podcast team. I'm not sure we've ever recorded 2 pods in a single day. Earlier today, we were interviewing Lauren Thomas of CNBC on all things retail. She's the retail analyst, and we were talking about store closings and earnings and such. Look for that podcast later in the week. So if we're a little bit, off the mark on this week in review, that'll explain it. A rare twin bill, and it's not one of those single admission doubleheaders where you got to pay twice. You get both of these podcasts for the same low price of $0. And it's not one of these 7-inning gigs either. You're going to get the whole 9 innings from me and Darren and Martha and Haley. Haley might be a little tired after all this editing. So going to the market, Monday we see a huge, I think unprecedented turnaround. The Dow has never seen a day where it was down more than 1,000 points and ended up in the black. That happened. The NASDAQ at one point was down 5% that day. Tuesday was kind of a rerun of that story, right? Huge losses early, but the indexes, went from deeply red to almost positive on Tuesday. Wednesday, we get the Fed conversation, which sees rates going up. In the immediate aftermath, the 10-year goes up 7 basis points. The 2-year goes up 13 basis points. So a real resetting of the Treasury curve. So rather than kind of dice what all this means on a macro level, what Darren and I are going to do is kind of talk about what this type of volatility means for CMBS and CRE. And Darren and I have been through a couple of the wars before when we've seen volatility like this. Sometimes it's meaningful to CMBS and CRE, and sometimes it's not. And we'll kind of walk you through that. So when markets correct, as the stock market has done over the last month, and again, over the last 3 or 4 days, it's for one of 2 reasons, right? One is that investors are reassessing the growth potential of stocks and deciding that stocks are overvalued relative to other asset types or to their future growth trajectories, right? Fixed income is more desirable, or lending rates are going to cause companies to have to borrow at higher rates, causing lower future cash flow, et cetera. Right. That's one reason that we see sell-offs. And that's what we saw with Netflix this week. Investors believe growth was slowing. Stock tumbled 30%. No one thinks Netflix is going out of business. And this type of sell-off has virtually no impact on the CRE markets per se. Right. CRE lending continues apace. Lenders make loans. Issuers bring conduits to market. Spreads don't move a lot because nobody is believing that the future prospects of tenants or credit is going to be impaired in the near term, right? So, and for that reason, that volatility doesn't extend over to the fixed income markets. We didn't see a blowout of spreads this week on CMBS bonds as the stock market was tanking, right? The other type of concern is that volatility is caused by credit concerns, right? This happened after the long-term capital fiasco in the late 1990s, during the dot-com bust, during the great financial crisis, and again in early 2016, when oil went to $26 a barrel and people felt that oil companies, especially exploration and drillers, might have credit events, right? But there's none of this in this particular volatile week and volatile month. When you see those kind of credit events, what normally happens is lenders pull back. You can't get loans, where you get loans on extraordinarily draconian terms, much wider spreads, right? We saw that in March and April 2020, right? That's not what's happening now. So if you're in the CRE market and the CMBS market, and some of what I'm saying is for beginners, because if you've been in the game for a long time, you know this already, that the volatility you saw last week is not spilling over into the broader markets at this point.
I think Matt is making a good point. These are not macro events that are impacting, commercial real estate, CMBS, or even, structured finance, fixed income assets as a whole. There's a big difference between, and you made the great point, and I'll just reiterate it. No one thinks Netflix is going out of business and that's why it's down 30%, or that going down 30% means it's going out of business. When you look at the fixed income markets, you're looking, and investors are out there and analyzing and putting their money to work. At the end of the day, it's two simple premises that you're looking at. You're looking at your return on principal, which is the yield you make, and your return of principal. If I invest $100, am I going to get my $100 back when my bond matures? On the first point, yeah, you adjust a little bit here and there based on what you think your yield should be relative to other asset classes, mostly comparing fixed income to fixed income, broader allocation switching from fixed income to equities to emerging markets and other things. But nothing has changed in the mindset of your return of your principal. You thought you were getting $100 back yesterday. The S&P went down 4% or 7% this year or whatever it is. Nothing has changed in your mindset from looking at the underlying credit that says, I'm getting my $100 back today. And I think that's a huge aspect of why the volatility is so much more muted, in not just in CMBS, but across structured products and across fixed income assets. I'll add a third new point to what Manus was saying, is that Rob Ott, if you've seen the Geico commercials, doesn't trade in the CMBS market. There are no algos coming in here and moving markets around, and we generally have a reason behind why spreads tighten or why dollar prices fall in CMBS. You can look back and actually figure out someone bought, someone sold substantially, who it actually was, a reason they did it, whether they reallocated to another sector or a margin call happened, i.e., March of 2020. The equity markets move because algos control a massive amount of it, and that's just not an input to a market like CMBS.
Renaissance man Darren King pulling out a anecdote from Mark Twain, who I think was the first one to come up with that remark about not caring about his return on principal, but his return of principal. I think it was his wisdom 150 years ago that first introduced that phrase. Darren, you belong on Jeopardy, my friend. Well, together, maybe it should be one of those team shows where we could each handle. You can handle CMBS, CRE, American literature, and I'll handle football.
For the time being, it sounds like developers, owners, borrowers shouldn't lose any sleep, but how did the markets perform?
Well, two answers to that. One is only modest spread movements on the secondary market. We were seeing AAA bonds and bonds up and down the credit curve move by a basis point or two each day, right? If this had been more of a credit situation, you would have seen AAA bonds moving 5 or 10 basis points in spread and BBB minus bonds moving 25, 50, 75 basis points. We were not in that realm. We were talking about low single digit spread moves. But the other tell, and I'll let Darren talk about this in a moment, is there were 3 conduit deals in the market. And when you get to extraordinary volatility that trickles over into the CMBS market, deals are slowed, spreads widen considerably, and sometimes deals are pulled or delayed, right? These deals continue to pace. We expect all 3 of these deals to price this week. I think it's the first 3 conduit deals of the new year, if I'm not mistaken. And, that's just underscores the point we made before, that it was very much business as usual for the credit markets in the face of the stock market volatility.
So yeah, Manus, the deals actually priced in the conduit space did so this week. AAA wise, really in line with where spreads were to close out the year last year, and the last couple of deals that came to market. And the market did see going into year end 2021, a little bit of widening in spread, not because of any volatility again in the equity markets, but because there were just a glut of supply coming into a time where everyone wanted to go on vacation and end their years and close their books. So you saw a little bit of that spread widening happen to the end of the year, and we've come in and started this year with levels right in the same vein, again, despite all the volatility going on sort of externally. So really, not much to see here is probably the opportune way of putting it. But what was interesting about some of these deals is that they're actually a little bit larger than we've seen historically, including one of the deals in the market at almost 1.8 billion is the largest deal we've seen in over a decade in CMBS for the conduit space. And even the other deal, 1.2 billion above average. I think for 2020 and 2021, the average size of a deal was $1 billion. So this is pretty significant to see deal size grow. And this is something that the market has kind of been talking about and alluding to for a long time, that it could be beneficial overall to the sector if we saw those deal sizes grow a little bit.
It was one of the big narratives in 2021, how lethargic or, limited, muted maybe is the word, that US conduit market had been in terms of issuance, right? It was really trumped by extraordinary growth in the CRE, CLO market and the SASB market as well. So I think it's great to see, between the three deals, we're talking about, I guess, close to a $4 billion or maybe a little bit more than a $4 billion a week across the three deals. You notice in one of the deals, a kind of a wrinkle in terms of loan composition. Tell us a little bit about that.
Yeah, again, for the first time in a long time, we saw one of the deals, this $1.8 billion transaction, actually had a significant portion of loans that were 5 and 7 year in tenor, 40% in fact. And that differs from the traditional CMBS conduit loan, which is 10 years in terms of its maturity. Everything's still on an IO basis, nothing changing there. That's just the way the market has moved itself in terms of loan structure. But seeing those shorter duration, shorter tenor loans is a unique feature to this deal. Just as a comparison, one of the other transactions that Manus alluded to has a single $3 million 5-year loan. The remainder of the $1 billion plus transaction is all 10 year. So for those investors, again, whether it's chicken or the egg, for those investors looking at, hey, long end of rates rising, a lot of duration, maybe not the greatest thing in a Fed hiking environment, you now have some opportunity to buy some new vintage, parish dollar price 5-year debt that the CMBS market hasn't really offered you a lot of in terms of fixed rate collateral.
This was a topic in Miami. I wish I could give credit to whomever brought this up from the panel. I think I heard it twice in Miami, that certain panelists were saying they would love to see the CMBS market expand more into 5-year product to help it grow its footprint and appeal to borrowers. And it's great to see somebody kind of take the mantle and run with it in that particular deal. Just a quick question on this particular topic, Darren. Do you think that, maybe you don't know, and maybe you just give us a gut feel, do you think that the creation of this 5-year product was more a case of issuers trying to expand their universe, or do you think it was more a case of borrowers demanding that kind of product?
I've heard a few issuers out there actually promoting this as something they wanted to bring to the market as actually a competitive product, in part to the SASB market and the CRE CLO market in terms of size, because one of the things that we've heard again and again is borrowers wanting more flexibility, that just locking in for 10 years, even if you've got a stabilized asset, you may want to sell it in a few years, in 5 years. You may not have a hold time that's that 10-year duration, which track to your loan. And as we know in the CMBS market, especially these conduit deals, it's expensive to get out of a loan. Defeasances, yield maintenance, these are expensive prepayment restrictions. If you want to actually reposition, sell, do something else with your property, reorganize your balance sheet. And so having a 5-year product that's available, I think there were some issues out there thinking that would make for an attractive offering, but you've got to be able to structure that into the confines of your conduit deal and make it work from that standpoint. So, like I said, the other deal has one $3 million 5-year loan that just it's small enough that it's probably unnoticeable. But if you had 30 or 40 million, it's kind of a weird mix. Whereas this deal where you've got several hundred million of 5 and 7 year loans, it kind of fits a little bit better together.
One other point I'll make about the 3 deals in the market this week, we saw something of an extraordinary green shoot. Maybe we should call this like a bamboo shoot or something bigger than your blade of grass we saw a 9-figure hotel loan make its way into the conduit market. I'm not sure. I'm sure we haven't seen a $100 million plus hotel loan in the conduit market since COVID began. Perhaps you could maybe call the MGM one out there, but that was originated before COVID. But kind of a green shoot, right? That issuers are willing to go out there and make a big loan for conduit purposes on something of that size, given where that market has been. So I don't want to give away too much of this because some of these deals are still in the market right now, but it was a green shoot for issuance in 2022.
Yeah, I think it's a good sign of really all parties in the market being able to get on the same page to get assets like this, just like the hotel market into conduits. You've obviously got B-piece buyers, AAA buyers, issuers, and rating agencies all kind of coming together and coalescing around, here's how we evaluate these assets. And hopefully as the market gets more and more comfortable with that, you're able to support more and more solid hotel lending in the marketplace.
Yeah, it's really a moving target when you come up with the metrics that you're going to say represents recovery from 2020 and 2021 to get these disparate parties to kind of see the loan the same way, the B-piece guys, the rating agencies, the issuers, and so forth, is a sign that we're, maybe use this word, coalescing around a certain level, which is a great thing to see. Hopefully we see more of it throughout the remainder of the year.
What is the takeaway here if you're not an investor in CMBS?
Well, I would say it's a couple-fold. If you are a hotel owner, it's another source of capital that you can tap, right? The more people that you could tap for capital, the better, because people are competing for your loan, and that generally leads to lower borrowing costs. That's a good thing. If you are somebody who's been lending to the hotel market, a non-bank financial institution, now you have more competition. And I think for the broader audience, I think that it's a vote of confidence for the hotel market in general. We've seen many over the last 6 months, from loan cures to payoffs and other things. And we're going to talk more about hotels later, but just another step in the recovery.
Yeah, I'll just add one point to that, is that just broadly having more of the financing options available, the way Manus said, also just creates more opportunity for asset purchasers of these. More transactions is overall better for the hotel market. Obviously, a lot of these assets over the past 2 years have dipped into reserves and things, financial means that they would have used toward CapEx or to do property improvement plans and things like that, just to cover debt service. So there's some deferred maintenance on these assets where if they start to change hands, that generally leads to new equity, new CapEx investment in them. And so more outlets for sources of financing to make those purchases improves the quality of the stock that's out there in terms of whether it be from limited service all the way through the resort level.
Turning to retail, several retail loan defeasances hit our radar last week, and they were subject of a number of our trading alerts. And in many ways, it was a positive sign for investors, but we're going to break it down and walk through exactly what it means.
Yes, this was kind of, if I can toot our horn for just a moment, this was kind of a market moving set of alerts that we sent out earlier this week. In short, what we saw with the January remittance cycle, the remittance cycle being for people outside the CMBS market, the reporting cycle where servicers report statuses of loans and whether they're delinquent or paid off or so forth, was that we saw several big retail loans, and by big I mean several that were over $100 million, that were originated between 2012 and 2014-15 that were defeased last month. All of the big ones were defeased by Simon Property, and we'll get into a little bit more of the mechanics of that in a minute. Most of the stuff was pretty high quality, meaning DSCRs of 2.0x or higher. So it wasn't the type of asset that people were overly concerned about. It wasn't that, as Darren likes to call it, the everyman mall with a 1.25x DSCR and one or two of the anchors has gone. This is pretty high quality stock, but nonetheless, people looked at this as potential sources of default should Simon say, you know what, this is not a core asset anymore. We're going to walk away from this. We're not going to try to refinance it. There's not enough equity in it anymore. So over the course of about 48 hours, we got a wave of these defeasances in, which we announced to our client base. Some of these assets touched CMBX 6 and CMBX 7. And what it did was, by taking this risk off the table, that CMBX 6 BBB minus spreads, which is where guys like Carl Icahn have made their bets. He's a short on the retail segment. Others have bet long on this. The price of that index went up about 3.5%, about 600 or 700 basis points over about a 24-hour period. And what that was telling people was that the sentiment of that trade, the dire nature of all these malls are going to collapse, not pay off, et cetera, became less dire over that 24-hour period or so. Spreads just really collapsed and prices went up.
I think one of the interesting takeaways from that is how little the volatility actually was coming into that. It's not like this was an index recently that's been moving around a point or two a day, 2-3% a day. The 2.5 months, frankly, prior to when we put out these trading alerts, moved to a grand total of 1 point. That was the range for 2.5 months span. And then, as Matt's pointed out, in 48 hours, the thing's moving by 4%. So really, the market taking hold of this. And I think to Mattis's point, it's not entirely about, okay, these specific assets necessarily made the entire market move up or change the default framework of CMBX 6 or 7. I think it was more that appearance that, okay, Simon is standing behind some malls we thought they might otherwise let go eventually. What else might they stand behind? What else might some smart manager, smart operator stand behind as well that isn't going to take this trade and all of a sudden take it to par? We're talking about a low 70s to a mid 70s type dollar price for the BBB minus 6. But it is that case of, well, is it 10% better? Are some of these loss severities going to be a little bit less? Is there one or two more loans that may muddle through and actually, make it versus default? And that at the end of the day is the difference between a couple of points here or there on this index. And so you probably saw, and we're not privy to the exact trades that are going on in the market, but you probably saw, a short or two out there get a little bit nervous and maybe cover some of it. You probably saw some of the people who are long and have been, struggling for the last year or two get a little bit bulled up. And maybe even some new entrants sort of step in. And frankly, to be honest, there are probably some folks who are like, nope, we see it. We think it's just as bad as it was and are using this, this rally as an entry point to, add to their shorts or start a new one for that matter. And frankly, all of that is good for, the trading environment and the liquidity of this index and frankly, for the liquidity of our business as a whole from the structured standpoint.
So I'll get a little bit into the inside baseball of this particular transactions and what made them work. But ahead of this, Simon raised $1.2 billion in debt, part of which seemed to be targeted to defease these loans. Why did they do it now? Well, probably because these things were close to their maturity date and the cost of defeasance was quite low, right? Defeasance is, for those that don't know, it's paying off your loan by virtue of replacing the collateral with U.S. Treasuries to replicate the cash flow of the loan. So Simon goes out, they buy Treasuries to replace the collateral cash flow. Those Treasuries cost X. It's usually some premium over what it would cost to pay the loan off at par. So it is costly. So what happened here, if we're kind of reading the tea leaves, is Simon raises the money, right? I think their 10-year fix was at 2.65% or 2.60%, right? Their handle on these loans was about 3.5, a coupon of 3.5. They're saving 100 basis points in the trade, paying a small defeasance premium, and all of a sudden their borrowing costs to keep this alive, these malls alive, is a lot more palatable. Thoughts, Darren?
Yeah, I mean, I think that's certainly a big part of the calculus here. I think for investors and, in whether it be CMBS or just folks out there, looking at acquiring or lending on retail, it's also a sign that they believe in the future of some of these just above everyman malls. This was not their class A plus product that was $1,000 a square foot in sales and all the Apple stores and the Tesla shops and and showrooms and that stuff. These were quality assets, but not their peak stuff. But by going through this exercise and defeasing it and paying that additional amount to do it, they're clearly making a commitment to this, because a lot of these are loans that were going to mature either later in 2022 or in 2023. And if you didn't have the intent of hanging on to them, you'd probably just muddle along, let the mortgage go, and then just default, hand back the keys at that moment in time. And they've clearly made the decision that these are worth the cost of this defeasance to hang on to and support longer than that 2022, 2023 period, or else they probably wouldn't have done this. I'm speculating on what's going on in their heads, but that seems like it would be the case.
So I have two more thoughts on the topic, and I'll run them by you here. The first is, if I'm looking at this market, I have two thoughts, right? Thought number one is, if Simon could do this once, they could do this a couple times, and we may see more defeasances come out of Simon kind of under similar terms, right? So I'm looking out there for the next 5 to 10 CMBX 6, CMBX 7 loans that might be candidates that didn't find their way into that January remittance cycle. I'm starting to think that, maybe I look at the same thing with Brookfield and see if they do that same type of trade where they say, let me lower my basis and do the same thing, right? Making a bet that this could be rinse and repeat. But I would also point out that it's kind of only the two of them that can do this, right? The borrowing cost for Brookfield and Simon is low. Like, this is not something that Macerich could pull off, or some of the other guys whose borrowing costs might be higher perhaps than the coupon on their loans.
Yeah, they're definitely in a unique position where they can borrow on their corporate debt at a rate lower than they can borrow on their asset secured debt. Obviously, that ebb and flow matters a lot. I think one of the other, I'll pull this one in from out in left field. Over the last couple of years, Westfield Unibail or Rodamco has talked about they're going to try to get out of the U.S. presence. Does this make anyone, look at those type of assets and maybe be a little bit more interested in them? Hey, Simon's clearly making a go of these, B+ malls. They're seeing something here. Someone who might have ignored this space, and we know that, right now the distressed mall sales tend to go to one of a very small handful of buyers at really, really distressed prices. Could some of these ex-Westfield malls be potentially more attractive? Has Simon figured out something in terms of how to operate these and make a go of them that could potentially raise the prices for some of these other assets that are coming to market, and a lot of which, and the reason I bring it up is a lot of which are in CMBS.
Well, we've now given a green shoot on lack of volatility in the CMBS market, a green shoot on hotel lending, and now I consider this a green shoot for the mall market as well. Maybe we should do double headers more often. What do you think, Haley?
I think she's speechless. Over the last year, the most frequently auctioned distressed CRE property type has been hotels. And we've done some deep analysis on the hotel loans that have been resolved with a loss in 2021 to give future bidders a sense of what the cap rates are for these assets. And Manus, you're going to walk us through what that analysis looked like.
Yeah, I have to give credit to Darren here because he plants a lot of these seeds in my head about alternative ways of looking at data. I've been at Trepp for a long time, and you get used to looking at things a certain way, and Darren has come in just kind of turning the lens a little bit, and it kind of leads to some interesting research. What we tried to do was to come up with a sense of what people were paying for distressed hotel loans or distressed hotels, meaning REO loans that were resolved with losses. What kind of implied cap rates to the 2019 NOI were people paying for these assets? So we took about 60 properties that were resolved with losses over the last 12 months. And what we did was we threw out the portfolio loans, and we threw out a couple of other loan types, and we looked only at conduit type of product. And what we did was we took the recovery proceeds that the servicer revealed when the loan was resolved or the asset was resolved, and we used that as the denominator for calculating a cap rate using the NOI from 2019. So what we wanted to do was give people a sense of what were people paying for these assets. Now, the science is not precise. On the one hand, what the borrower is paying is usually something more than what you get in recovery proceeds. They're paying brokerage fees or auction fees, things like that. On the other hand, a lot of times there are some untapped reserves left, which the servicer or special servicer grabs, which inflates the liquidation proceeds. So we try to adjust for how much reserve was left for the asset in the month prior to the liquidation of the asset. And I have to say, we were kind of surprised, and I'll be interested to see what Darren said, but we looked at extended stay, we looked at limited service, and we looked at full service. And by and large, what you were seeing were cap rates on the basis of how we were calculating this, kind of in that 10 to 14% range. There were outliers, there were some lower and some higher, but given the buoyancy of the bid that we've seen over the last 6 months, I was expecting something lower. But what we really saw was kind of, low double digits.
Yeah, I was surprised as well. I thought it would be a little bit lower, but I guess, you have that sense of we're doing our calculations, or Manus, you're doing your calculations on this off of 2019 numbers. So, some of these assets may actually be underwater when you're buying them. So you've got to factor in the fact that you may actually be running negative for a little while, or how much work you have to put into it. I mentioned earlier about kind of deferred maintenance and CapEx that especially for a hotel, is pretty significant on an ongoing basis that may have been neglected during the pandemic. So there may be some more costs and expectation of that that you're baking into your price. I guess one of the questions I'll throw it back at you, Manus, is the individual results between limited service and full service were a little surprising to me. Limited service, I think, was around a 10.5 cap rate, and the full service stuff was, what hit that 14%. Any thoughts as kind of why the full service was the underperformer?
Nothing immediately jumps out other than the fact that there are timing elements to this, that if you resolve something in early 2021, before we started to see the light at the end of the tunnel, where people started getting vaccinated and so forth, that you probably got much worse execution than you were getting in the last 3 or 4 months of the year. So I think there was a time element of that. And because the data is so lumpy, that may have been enough to move the needle. But the good news is, 2 pieces of good news for our listeners. One is we're making the report available, our findings available. So for people who reach out to us, we'll send you the report. As a secondary thing, because we think that there's a lot of nuance behind the data, if you're willing to fill out a form which tells us who you are, we don't want people coming in with Gmail accounts that we don't know which firm they're with and so forth. But if you're willing to tell us who you are and not come in via a Gmail account or as a lurker, we'll actually share the raw data with you, and you can look at it and give us your thoughts for future podcasts. So, but to your point, Darren, I think that the longer you stare at this, the more findings will come out of it.
You get the chance to dig into the data, listeners out there. I think there's some fun things to look at, not just in terms of the cap rates, but also in terms of balance per key that these assets are trading at relative to their loan balance, and so you kind of get a feel for some of the loss severities and where you're coming in versus where you're going out. So some interesting aspects of the data to dig into a little bit further as well.
Yeah, the real goal here was, we hear about new entrants coming in and taking part in the 10X auctions and the Real Insight Marketplace auctions. And what we were trying to do is help those people out, right? To give them a sense of order of magnitude, right? What might it take to help me compete for this particular hotel and not overpay? And so hopefully this data helps a couple guys out there get some deals done.
Yeah, Manus, for like the equity buyers out there, do you have a sense of what kind of the average ticket price was for these assets, like in terms of just how much these hotels were selling for?
I don't have the spreadsheet open, but I think we're talking 10s and 20s, something like that. But there were some under 10, right? But, we're not talking about $100 million, $200 million assets, right? We're talking about the lower end, which is consistent with what we've seen on the auction sites, right? We're seeing those smaller handle assets come up for bid. Perhaps it's because those bigger assets are really still being handled by the brokers and are on a by appointment type offer, right? Or kind of a more formal and traditional way. So the stuff we're seeing is kind of, I would say 20 million and less generally.
Turning to our shout outs, John T shared our hotel analysis, which we've just talked about. Great info from TreppWire, and gave you a hashtag Manus Allman Brothers, and our loyal listeners will know exactly what that means. So thank you for John. Richard C on Twitter shared our CRE loan performance report, talked about delinquencies after Q3 reporting. If you're interested in that information, give us a shout. Natalie S. of Cranes shared some of our information. Avik M., our hotel resolution analysis. And again, thanks to Lauren Thomas from CNBC for joining us to give a real deep dive on some of the reporting that she's done on retail and some of the observations she has of upcoming earnings reports. And Susie S., who was very observant in the all right that's quoted at the very end of our podcast. If you don't listen all the way to the end, you don't know what I mean. But we had a little different voice at the end last time we had a recording. So thanks for Susie for noticing.
Well, I'll throw one more shout out. This is for Joel, who's a longtime listener. He and I got to golf together a couple of months ago. He is so dedicated to the podcast that he was listening while on a cruise with his wife. And he gave us a couple of details on the cruise, which when I saw them was a little discouraging. He said about 35% attendance on the cruise, and the cruise liner had already announced it was going to be their last cruise until May. So thank you, Joel, for your loyal listenership.
Time for the NFL playoffs, guys. Who are your favorites?
Well, I will certainly be watching the games this weekend. You know, I spent, whatever it was, 16 hours on the couch last weekend. It had to be the greatest weekend of NFL.
I don't remember ever
football,
seeing such great games ever.
In that window. I'm going to be rooting for the Bengals. They haven't won anything in a long time. This was their first playoff win, I think, in 31 years, something like that. Their fans are so juiced. I'm really looking forward to that. On the other side, kind of indifferent. Rams, 49ers, they've played each other twice already so far. I think the Rams are the more interesting team to watch, but I think the 49ers kind of have their number.
So I'll say maybe the most controversial thing, I'll leave it to the listeners to decide, that the podcast has ever said: I love overtime the way it is.
Oh, yeah, that's horrible.
Well, I love the whole debate here that people are screaming in outrage on Twitter and, other social media boards. It's not like this wasn't going to happen someday, right? It's not like this rule was implemented yesterday and we got hit in the back of the head by this. This has been out there as a potential problem, I don't know, 25 years or something like that. But I'll give one more thought for the weekend, and this is kind of going a little far afield, but I rarely do product endorsements, but I will do this one for the Omicron period, because once I was done watching football, I took part in this thing by Dan White Magic. He's a magician. He used to be on Broadway, and because of the Broadway shutdown, he now brings magic to your home, and you can watch this on Zoom. It's about the same cost as going to see a show. So I think it costs about $125. Up to 4 people can watch at the same time. He sends you a box.
It's amazing.
With all the things you need to have the magic show in your home. And it just completely blew me away. So if you're in a location that is not fully open yet, or you can't take your kids somewhere, and you're not into NFL football, like I said, I don't know Dan White. I'm just doing this kind of off the cuff, but it made for a great weekend with me and my kids, and good for him for kind of figuring out a new way to stay relevant in kind of crazy times.
I agree. I did. I also saw it over the Christmas break, and I got to tell you, it was unbelievable that he can do the magic that he can do. I don't know. It's obviously choreographed very well. So I agree with you. So it's worth checking out if you can go to one of these events. I went to one through a corporate sponsorship. It was great. So Darren, see what you're missing?
Darren wants to make Manus disappear.
I think Haley can do that.
Clever editing. We can do just about anything, right, Haley?
That's right. With that, we will close. Thanks to our producer, Haley Keene. We'll be back next week with what's happened during the week. and how it may be impacting you. If you have a question or comment, send an email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening. Let's go Bengals and stay well.
All right.